So back then, the Midwest only had a handful of firms, and it was a rapidly growing as far as the percentage of the deals in the US that were based outside of the Bay, outside of New York, outside of Boston. More and more companies were starting here, but they were still finding it really hard to find capital.
Welcome to Partner Path, a podcast that unpacks the venture capital and growth equity ecosystem from a junior perspective. Young entrepreneurs and investors have already had a massive impact on the industry, having started unicorns and launched billion-dollar funds. We discuss these success stories and more by sharing perspectives and advice from some of the industry's most prominent role models. This podcast expresses our views as of the date published and does not represent the views of and is not endorsed by any company for which we work.
We are excited to sit down with Victor Guwein, managing partner of founder M25. M25 is a leading early-stage venture firm located in Chicago, investing solely in the Midwest. Victor started M25 at 23 years old after founding Versity. Welcome, Victor.
Hello. Hi, Laura. Hi, Will. Thanks for having me.
Thanks for being here. And let's dive right in with your first company, Versity. What was the impetus for starting a scooter company?
It's kind of silly. I have always been all about efficiency and moving faster, getting things done faster. So when I went to college, I actually brought my old Razor scooter with me because I wanted to get around campus faster and do more activities, be at more parties, whatever. I quickly broke it because those things are not designed for grown adults. But then I looked into what other options were there, and I saw that there was more adult-sized scooters, and thought, this is maybe I'm onto something. This was before Bird and Lime. This was before last mile mobility was really a thing, and I kind of was convinced that this could be a category, and this could be something that, especially, you might have an early uptick on college campuses. So I started to get a wholesale relationship and a brand around it, distributing. But I had a rental model, an ownership model. We didn't get it very far. I don't want to overstate how naive we were and how early to this we were. We looked at electrifying them, but we didn't have the engineer on our team. It was kind of encouraging to see then that this category as a whole, we were early to in some way, but as a whole, it really was just kind of more of a formational experience and got me involved also with other entrepreneurs on campus. What I took away from it, except I still do use my scooter a lot. So I will say that I'm a big fan still.
And then fast forward, you were 23 years old when you started M25, which is younger than I am now. It would be hard for me to start a fund at 25, much less 23. So it'd be great to touch on how you started M25. What made you think of the idea to start a venture fund?
I had been spending time with students on campus that had other businesses. Maybe somebody was launching a mobile app. Somebody was launching a 3D printing company. So I had been spending time with those founders, and ultimately the university decided to encourage us and plant a seed of, hey, do you guys want to start a venture fund, a student-run venture fund? And so they gave us an initial relatively small amount to start investing in other campus founders. So these were other students that also had ideas, maybe like me, and we would run it like a venture firm. We had a due diligence process, we had a pitch process, partner meetings. That was the first time I had really dove into what venture capital was, and it opened my eyes into this being a different path for your typical UChicago econ major to take. There's investment banking and consulting were kind of the two default paths, and I wasn't necessarily passionate about either one. And so I started looking deeply into, is venture capital a career path for me? And the short answer for most people coming out of undergrad is that it definitely isn't. There's not enough roles, there's not enough, you need more experience to get into venture capital for most firms. It's a very small industry in the scheme of things. So I didn't have immediate access to go into venture capital. I did a couple years in corporate strategy as I was networking and talking to people and trying to discover what the opportunity for me in venture capital would be. And it wasn't entirely obvious how to get a job, but then I kept coming back to that there was this maybe more overlooked area of the market, the Midwest, which is where, as many people know, M25 now, that's where we invest. That's where we spend all of our time. We're based in Chicago and we focus on the broader Midwest. So back then, the Midwest only had a handful of firms, and it was a rapidly growing as far as the percentage of the deals in the US that were based outside of the Bay, outside of New York, outside of Boston. More and more companies were starting here, but they were still finding it really hard to find capital. I mean, yes, that's a market inefficiency or an arbitrage opportunity that I was clued into with my Chicago econ background. But more thought, it's also a place for somebody that lacks experience, lacks the pedigree of working at other venture funds to maybe get their start in venture capital. Because people knew that I had been digging in and had this entrepreneurial background and passion and done some stuff in venture capital, I was able to convince a handful of friends and family to back me on Fund One. And that was in 2015. I was 23 years old, so I quit my corporate job and went full-time operating our huge Fund One. It was $1 million. Okay, so not to overstate Fund One. That's a half of a check for most funds. That's where we got our start, and then quickly leveraged that like initial angel type fund, size of fund, to start to raise our next fund, which in 2016 we raised $11 million, which a lot of people would call that like our first like real fund or our Fund One.
And where did the name come from?
Myself and then who became my partner, Mike Assam, we're both Christians. And so M25 is a biblical reference to a passage in Matthew 25, which just the quick Spark Notes version is that it's about a master giving his capital to a steward to his servants and to take care of while he's gone or traveling. And he comes back a year later, and two of those servants have taken the money and built like a small business and doubled their money by creating a business in the marketplace, whereas one of them just buried it in the ground to keep it safe. And so the master blesses the servants that used the money, took some risk, but also worked hard, used the talents that they were given and the skills and created something, and ultimately made more with it. And he cursed the one that just kept it safe. Because myself and my partner are Christians, we view that as like a biblical example of venture capital and doing what we're doing. So I thought that was a very inspirational name, kind of had our values up front as we started this venture.
And ultimately, I mean, you raised a fund too. However, going back to Fund One, you still have to have a strategy in place and find the best deals to ultimately drive returns for your LPs to be able to raise, hopefully, a bigger Fund Two. So, I mean, what was your strategy going into Fund One? And like, how did you start to build that track record with such a small amount of capital?
It wasn't like it took off overnight. What happened was we had this $1 million Fund One, and we're nobody. Nobody knows of us. There's no brand. There's no deal flow naturally flowing our way. I wasn't spinning out of like an early Google employee that had all this deal flow coming their way. I did a couple of things to like really accelerate. I joined a couple of angel groups early on, including Hyde Park Angels here in Chicago, which is like kind of a more larger and well-known one. And I led their consumer team. So became more of an expert because I had a little bit of a consumer background with also my corporate career too. The person that would go to every startup event across the whole Midwest. I drive from one night I'd be in Cincinnati, then I go to Columbus, and I go to Indianapolis, and I'd be at everything and be very accessible, it's hard to find, even though we were writing 25, 50K checks, it's hard to find that, especially 2015 in the Midwest, to find somebody that would be willing to invest in a risky asset class like venture capital. I mean, this is where people in the Midwest have made their money on farmland or real estate or agriculture or manufacturing businesses. And nobody's at cocktail parties or the golf course talking about, oh, did you invest in that startup? I made a bunch of money on that, that exit and that sale to, IBM. Nobody's saying that. Now they are, but back then they weren't. And, so I was accessible. We had a brand and a website that was like very crisp and clear. Like, here's what we do. Here's the stage we invest. Here's how to reach us. It was this scrappy, but just also doing something that really hadn't been done a lot in our market. If you're in Silicon Valley, it's like, well, duh, that's what you do. It's to source deals. Like, that's because it's a lot more competitive in an environment. Everybody's doing that. But I think in the Midwest, it hadn't really been done. Some people had even said, hey, you're bringing some of this coastal style to the Midwest, which had a lot of opportunity. We weren't leading rounds. We were trying to participate and get into high quality rounds, which, because we were so relatively aggressive compared to our peers on the coast who weren't necessarily aggressive, but because we were so aggressive, we were thoughtful, transparent, we were able to get into these rounds that were raising $1 million, $2 million, because frankly, there wasn't a lot of that follow on, or like, it was hard to build a syndicate back then. It was hard to get the capital into these companies in the Midwest.
Very, very helpful. And I want to move into how things have gone. But maybe before we touch on actual performance at a high level, could you maybe just explain for the audience how venture capital firms actually generate revenue, the concept of a management fee and carry, and what that means?
Of course, because I did hint we were a relatively small fund, which means that we also had relatively few management fees. So a management fee is, you generally are taking 2% of your committed capital every year that you're during your active fund period. And that is going to pay for salaries and other expenses. Salaries are usually the bigger one, but also it could be office, travel, food, whatever, to run a business, to run a company, the software we spend, that type of stuff. You can imagine we might have had 4 people towards the end of fund 2, all full time, that were making 2% on $11 million. Actually, a lot of emerging managers, you'll front load, you'll do 2.5% and then wind it down, so it averages to 2%. So we did 2.5%, but still, like, it's not that much money. I think that showed dedication to our LPs. That we were like in it for the incentive of the long term return, which is the other piece of it. So that's the 20. Usually people take 2 and 20. The 2% is the management fee. The 20 is the carried interest, and so we were heavily incentivized to draw significant returns for our investors by getting a 20% share of the profits, not of all of the returns. First, you return all of the capital to your investors. Then you take a 20% share of the remaining money. And that, depending on how each firm is organized, you'll be splitting that amongst your team. And so that's the carried interest. That's what's often referred to as the carry or the carried interest. It looks kind of like, if you're working at a tech startup, it works like your options or your option pool is how it's often described, how like this, they're similar in a lot of ways. That's supposed to align incentives. Of course, when you become a really, really big firm, then the management fees become very big, and maybe that's more attractive than the carry. And that's a meme or a common complaint amongst investors and GPs alike. For smaller funds, the carry is much more interesting and definitely aligned with what we are hoping to drive long-term value for our investors. It's very, very common to do 2 and 20. Of course, you can deviate from that, but that's kind of the rule of thumb.
How do you think through price setting when it's not during a round? If someone's looking to sell and someone's looking to buy, but it's not an official capital raise, like who sets the valuation there?
The easy and complicated answer is both. It's a market, supply and demand. A lot of times people are looking at revenue multiples, and those have, as we all probably know, those have come down pretty significantly. So there was people that at some point, for like some of the craziest companies, they were paying 100x or 200x revenue multiples in 2021. We're far, far from that now. Where most, except maybe the most hyped AI companies, we're talking about multiples more like in the 10x range, sometimes below, sometimes above, depending on the growth profile and the type of company it is. We might look at it ourselves as, hey, where does this stand? What is the current revenue multiple? Does that seem high? Does that seem low? But we don't actively change our own valuation positions, what we report to our investors, unless there's been a certain time since the last round, or unless we know that there needs to be marked down, depending on a situation, like the company's not doing well. I mean, sometimes we've looked at it when it's way overvalued. There are some edge cases here and there too.
And you touched on a little bit about providing access to potential portfolio companies as a sourcing strategy and kind of traveling a lot. I'm curious to hear now what you feel like the M25 DNA is for sourcing.
So here's the fun thing is, when I first started, nobody knew M25. We were brand new and we had very little network. So we're the most active investor in this 14 state region. We've done the most deals. We have 130 something deals in the past 8 years. And it's not just Chicago. Chicago's about a third of them, but there's 25 cities we've invested in. Some of these cities we've invested in 5, 10 times. So at this point, if you go to Columbus, Ohio, or St. Louis, Missouri, or Omaha, Nebraska, we've made at least 5 investments, maybe 10 investments in that city. And some of those investments have now raised 10 million or 20 million or $50 million. There's not that many companies in those cities that have done that. And so the M25 name has gotten out because They'll go to that founder, they'll look at that founder's cap table if they don't know that founder directly, and they'll ask, who did you take your first million from? Who's been your most helpful investor? Who should we pitch for our pre-seed or our seed round? I don't want to speak for every founder of ours, but we have done a lot to help our companies from the get-go, try to be outsized value add compared to what people maybe expect from a check size like ours. And that has resulted in really, really great referrals, both from the founders we've backed, but also from our co-investors. Because I think we've tried to really be working collaboratively with co-investors in the region. That's paid off. And so we get great deal flow across the region from that. Not to say that we're not hungry, that we're not going to the events. We still have a very robust travel schedule. We have more people now that can go to events too. So we're really everywhere. It's something that we're hearing about the deals before they're pitching at competitions. As soon as somebody's spinning out of a unicorn in Cincinnati, we're looking at that opportunity to see if we like to invest in it. That's taken a lot of groundwork. That's taken a lot of investment and time and building relationship. That was kind of what I was hoping we would get to when I started, but it's been really exciting to see it pan out more.
And it seems like that's almost the way to win nowadays at the pre-seed and seed is really be at the inception of these companies as people are spinning off from unicorns or tech companies to start, hopefully the next big thing. Additionally, when you're investing early, you're putting a lot of trust in the founder because you're essentially investing in the person and then hopefully the product and market as well. But sometimes, well, a lot of times they don't have product market fit and might not have any customers. So who knows if anyone will want to buy the product. And you've touched on in previous interviews and posts about your scorecard method. How do you at these early stages determine if a company will be successful given I don't even know if there's unit economics involved at this point?
There's so much nuance and there's so much subjectivity. And when I first started, one of the goals was to try to, you can't remove that, but you can try to make it more consistent, like trying to make consistent decision making and trying to add objectivity into the decision making process. And so that's why we built the scorecard that we still use. And it's like continually enhanced. Like we're always trying to improve our scorecard. The way also I think we operate with our deal meetings and stuff really helps to add and focus a more consistent and objective investment process. For example, there's a team category in our scorecard. And people might, in general, when you're making early stage investment decisions, you might be like, well, that's a great team. Or maybe you go one layer deeper and say, hey, that's a great team because they have experience at this startup or in this industry or whatever. We're trying to score what makes a great team across, there's probably like 15 different variables within the team category in our scorecard. And we're saying, okay, on the industry experience, how does this compare to the average startup we're reviewing? Is it plus or minus like a certain point range that we think of that of how important that category is? And then we go to the next thing. How about for startup experience and track record? What about the variety of skill sets? Do they have everything they need, or are we going to have to add people? And how does that compare? So everything's comparison against what our typical or average deal that we review is. And so that allows us to more consistently discuss this is 50% better on an industry experience than our typical deal. And then it ticks up the score. We're not going to make a decision entirely because the scorecard is 100% positive or 100% negative, but it definitely guides our decision making, and it has helped to create way more consistent approach. And also, I would say our team is more aligned because we have 5 people now on our investment team. We're more aligned during the conversations. So, hey, like what is going right with this company? What are we worried about? And then we can pinpoint like, yeah, well, we saw on the market opportunity side, it's a really big opportunity, but it's not growing very much. Or it's a really big opportunity, but hey, there's actually like 15 startup entrants in the past 3 years in this. So it's going to be kind of a crowded space to get attention with lots of venture money that we're fighting against. So there's going to be aspects of that we can be aligned and make a more, hopefully a better decision in the long run.
The next topic I want to talk about, which I think is fairly unique to pre-seed and seed investors, is valuation, something that you've mentioned on a couple other podcasts. Specifically, you've mentioned the importance of entry valuation. You mentioned that the M25's biggest return or biggest mark to date isn't necessarily the highest valued company. And so I'd love to hear you just speak about your rationale for why entry valuation is important at the pre-seed stage. I think it's something that a lot of investors typically take a more binary view on, and that entry valuation of the seed might not matter because at the end of the day, it's either going to be a 100x or a 0. And so I'd love to hear you just kind of speak to your thoughts on entry valuation.
I have a lot of opinions on this, and I also am cognizant that I invest in a landscape that still has a pretty big arbitrage on valuation compared to, like, New York and San Francisco. So it may, and for different reasons, I don't want to necessarily lead people to the wrong opinions here, but the most important aspect is when most of the people that are saying, hey, if you invest, it doesn't matter what price you invest at, because if it's $1 billion, you'll it's going to be a win. As long as it's a winner, you're going to make a ton of money. It doesn't matter what point you get in at. Well, if we draw that to the extreme, if you invest at 1.1 billion and it sells for $1 billion, then yeah, you didn't really make any money. So it does. But also, if you invest at 10 million post money or 5 million post money, and it sells for $1 billion, you made half the money if you invested at 10. Now, maybe you wouldn't have been able to get it at 5. So you have to make those decisions. I'm not saying that there aren't reasons to pay more or to increase what you're willing to pay, but you do need to think about it as, especially because almost all of our investments, we're investing below 10 million post money. We're truly a pre-seed investor. And to go from 4 million posts to 8 million posts, we know that we're halving our potential return. And because that $1 million, that 500K that we're writing now out of the current fund, that's buying half the equity. So that is, we negotiate every $1 million movement in valuation pretty strictly. Not to say that we won't negotiate, but it's just saying that we factor that in and we look at it compared to the quality of the other deals that we're looking at too. We try to, like, okay, well, if we can invest in this one at this price, we'd like to do that. Otherwise, we'll do this one that we both think are really high potential companies, but everything's a risk reward for us too. So we will often say in a meeting, we need to be compensated. It's a big opportunity, but it's a lot of risk. So we need to be compensated for that risk with a lesser valuation than maybe you might do something at a similar stage or that looks similar. And I did a whole post on this this was maybe 3 or 4 years ago, but the math is way more important for a small and early stage VC on this. The later stage investors or the larger funds, first of all, at seed and pre-seed, they really don't care because they're just trying to get money to work. They also have to write a certain size of check to make it worth their time. So they can't invest 5 million at a 5 million post. That would be 100% of the company. They have to do a 20 million pre-money or maybe a 20 million post money at the lowest end if they're trying to put 5 million to work. And they're trying to put more, the economics change to deploying raw amounts of capital versus getting the optimal return on a relatively small amount of capital, which is what me and a lot of my other peer smaller funds are tasked to do. So a little bit long-winded there, but that's kind of why we have pretty relatively strict and valuation sensitive policies.
I'd love to hear the extrapolation of what the impact of kind of higher multiples today have meant in venture. Obviously, there's a ton of supply and some more demand on the West Coast and East Coast, as you mentioned, but there's still rounds happening at 100x multiples. I think Hugging Face announced last month that they raised it a $4 billion valuation, which I think was roughly 100 times multiple. And so what are your views on the venture world will reconcile back to maybe valuations that historically were more prevalent, or if this is something that's going to persist? Is it going to require an impact to venture returns before we actually realize and bring down the multiple kind of valuation market?
Also, I would caveat probably remove AI from your answer because as you saw, like the AI deals are impacting the valuations more than the other ones.
Well, I mean, you could also just look at AI too, but yeah, just in general.
But that's the hype right now, or it won't be the hype forever.
I do think the interest rates, sometimes it's understated how much of an impact they're going to have on venture capital, because if they remain elevated, and they're not necessarily elevated in the long run, they're maybe more kind of normal. We're investing in things that will be profitable and hopefully insanely profitable, but further than 10 years down the line. Like Amazon went public super negative profits, and then it took them years. And now a lot of these big tech companies that are publicly traded are very profitable, but it took them a long time. And so everybody that's investing in the companies, it's in the long run, it all goes down to a DCF or a discounted cash flow. And the discounted cash flow, the interest rate is one of the major factors. When we've more than doubled interest rates, that has an insane effect on like what present value for a company should be and what the present multiples for something that isn't profitable now, but will should be profitable a long time in the future should be. We might not, for the majority of companies, might not see multiples consistently be well above, 10x or 15x, even if they have really strong growth. There will always be outliers, there'll always be extremes. So like it's AI this year and it could be something else next year that will have people justify extreme valuations. And some of them will be right. Like I don't want to just throw those out. Some of those will be right. We've always been valuation sensitive. In 2021, we had to, in order to take the same valuation range, we had to compensate by taking less traction. The companies that weren't as far along, I think we had this insane stat where the 2 years prior to summer 2020 to summer 2022, there was that 2 year run that really got heated. Before that, probably 5% of our deals had been pre-revenue. And then it went to maybe 40 or 35%, I think, of our deals were pre-revenue in that hot period because we wanted to still maintain our entry point, our really low valuation entry point. And so we had to give up revenue and other forms of traction. And now we're back to the point where there's going to be relatively few companies, at least for a Midwest pre-seed, that don't have any revenue or any customer traction. Whereas our average valuations basically stayed the same year over year over year because we just kind of throttled on what we're willing to accept based on what the market's having us. So we're probably, I think, in the long run, that 2020, 2022 time period is going to be pretty much an outlier, but I don't think we're going to lose a ton of momentum. And venture capital is still going to be an exciting asset class and have lots of activity. It'll just be more 2017, 2016 type valuations. That's how I would predict it.
And you've mentioned earlier that M25 has part of the differentiation relies in the geography and your focus in the Midwest. How do you compare that to, or how has that been impacted by the exodus of founders and tech firms from San Francisco? You're seeing just generally more globalization, but also decentralization across the US. Austin's becoming a hotspot. Miami's becoming a hotspot. New York, there's a huge fintech community. As founders and investors continue to spread, how has that impacted the relative advantage that you've seen in the Midwest and having your presence there?
COVID was a major contributing factor to this, where people on the coast could still invest in the Midwest or other non-regions that weren't like a direct flight or right down the street from them. When I first started, I had countless venture capitalists be like, how can you build a big company out here? Or I don't want to sit on a board in Indianapolis or Des Moines because that's 4 times a year to go out there for a board meeting. I don't want to have to deal with that. Now, most board meetings are probably still held over Zoom, and then maybe once or twice a year, they're going to go to that market that they wouldn't have spent time in otherwise. But there's also more activity in those markets that they would have otherwise found because we have seen a huge uptick in activity, and not just from an absolute basis, but from a relative basis as well. All of the, like San Francisco as a percentage of U.S. deals is still the dominant player, but it's gone down as a percentage of U.S. venture activity, whereas all these other cities have increased as a percentage. Some of them have become really trendy, like Miami and Austin, but every city has basically seen growth. Now those cities are also seeing flywheel effects where they have had major funding events and major exits that are recycling and starting new companies. So 2 examples in our market are Ann Arbor has had 2 major unicorn exits, both in cybersecurity, Lamasoft and Duo Security. And we've actually backed 2 companies that have execs or leaders there that have spun out and started new companies. And there's others. There's probably like 4 or 5 that I know have gotten significant venture funding in that Michigan community. And then the same thing in Columbus. We have seen a lot of companies come from the Cover My Meds exit, which was the first unicorn exit in 2017. And that has started a lot. That's more in the healthcare software space, but that has started a lot. And we've backed 2 of maybe like 4 or 5 that have come out of that ecosystem. That's attracting coastal capital. Like, oh, big exit's going to happen here. That's attracting capital here. That's attracting experienced teams and founders. I don't think the Midwest is the only place that's happening. So I know it's happening in Atlanta and Austin and other places, Denver and stuff as well. So, but we're definitely seeing it here. And I think that's here to stay, even as we do still Most of our companies still have offices and have headquarters where most of their employees are. They may not be 5 days a week. They may still have some remote workers, but in general, place matters. And we're seeing a lot of exciting activity in the same ecosystems.
And quickly, what advice would you give to someone looking to raise their own venture fund?
I was pitching myself, maybe Vincent Gutwein or something instead of Victor Guwein, the younger version of me. Like, if I was pitching the same strategy to me, it would be like that time was 8 years ago, 9 years ago, 10 years ago to pitch a story like M25. What's going to work now? Whatever worked for somebody is not going to work for you. You can learn from that and you can, okay, so I need to chart this type of a course and I can learn a few data points. I have this like saying that you should gather all the advice. Like you should get a lot of advice, but don't take it. Don't just take what somebody says to do. You have to gather it all, but you have to and understand why they're saying it, but you shouldn't actually like take the advice, like if that makes sense. If you were going to launch a venture fund, like where's the puck going? What's going to be interesting? And I was in the middle or maybe even slightly early middle of this rise from a couple hundred micro VCs to 3,000 micro VCs in 2021. And now there's going to be many that don't make it with kind of this downturn, but we will still have a lot of micro VCs and lots of strategies. And so what will be something that you can excel at, that there's an opportunity, it's not super crowded? I mean, just creating a startup in a sense to kind of go after that. So that's the advice I would tell Vincent Gutwein, my 8 year younger, 10 year younger aspiring VC.
To wrap the episode, we have two questions. The first one is, what motivates you to work hard?
I do have like a very innate hardworking work ethic because I'm from a family of like farmers and small business owners in the Midwest with German roots. So there's probably just some element of that. I'm so fortunate. I wanted to be a VC and I was able to do that and kind of strike out this path that I can do that. I figured out what I wanted to do early and was able to get into that. And many people don't even know what they want to do and then let alone get into that career path. And so it's more that it doesn't feel like I'm working hard all the time. It feels like I'm just doing what I love. And sometimes it's hard to turn off. I mean, now I have a wife and a family of 3 children. And so that becomes a problem sometimes because I'm so excited about my work and it can be hard to not work hard. If that's not the way it is as you're looking at venture or like starting venture, it could be that that's not the career for you. Maybe there's something else that would give you more energy. For at least some people like me, it can be what makes you tick.
And then for the second question, you already touched on a piece of advice for emerging managers, but what's a piece of advice you would give your younger self?
Maybe I'll give something really tactical because I kind of already gave this idea of how to learn from others. But from a tactical sense, the value of compounding network. Early in your career, you have a lot of time and you don't have a lot of people that actually want to meet with you like as much because you're less. And I think that was one of the most critical things I did early on was just meet a lot of people, establish a lot of relationships, get our story out there, get what I was doing out there, because it's amazing how much that compounds in the future. If you can do that early, try to be helpful, but a lot of times you have hardly anything to offer people. But like, you try to be helpful, you try to get that relationship kick-started. And then maybe it could be 5 years down the road or 10 years down the road that you need to call that person up and ask them about something or ask them a reference or get a data point or like ask for an intro. Early in your career, that's what you can really do well because you have relative to later, you have a lot of time and try to hustle to get to meetings and add value to people.
That's a great piece of advice, something that all of us could certainly learn from, especially at the younger side of things. Victor, thanks so much for coming on the podcast. I think Laura and I were really looking forward to this one, and it's certainly been a really fun, interesting conversation. So we both appreciate your time.
Awesome. Yeah, it was really fun. Great questions and hope it helps. And thanks for having me on.